Again, welcome everybody. We're gonna start this. We're gonna look at USD JPY. Screen share now. All right, solid. So this is USD JPY or US dollar versus the Japanese yen. The first thing that you want to do, as I teach everybody, first thing first is to check those indexes. So for US dollar, that index is the DXY. So I already got it typed in up here. So the DXY is actually positive 24%. It's at 95.39. Okay, so that's actually a good thing. All right, so anything above or below 10% is considered a true trend. As I stated in the last training, the one before here. One other thing that you want to be paying attention to throughout the week is that currency price. So 95.39 is the actual price for the dollar. I want to see if that increases or does that decrease. And that's going to give me the idea of, is that currency pair strong or weak? In this case, the US dollar is strong. Let's take a look at the Japanese yen. That currency pair index is the JXY. Right now it's at 89.8 and it's negative 14%. So in all reality, it's weak. So my natural bias with this information that I currently have is that the US dollar is stronger than the Japanese yen. Now this chart that I set up, I actually set it up on a higher time frame. So I went from the monthly down to the 4 hour. So I did a higher setup. Now this is for basically longer lasting trades. Okay, so my general bias is basically mapped out according to what the market is doing. I can use this setup to scalp, and I can use this setup to swing trade as well. Now my first move. Now this is how I'm basically reading this setup. A lot of people that has been through my trading or going through my training now, they can kind of see what I see. Once I finish this move and I get to this 38.2 zone, my outlook on it is that the market will begin to retrace. Okay. Now, what is going to allow me to know that it's retracing is these lines that you see coming horizontally across the screen. That's basically what we call channels. Now, that market basically is telling me that right now we're starting a bullish trend. So we're going to start to go up. But this red channel, this red line, is telling me once the market comes outside of that red line, then that's ending that short-term bullish, momentum. Okay, so what I'll be waiting to do is two things. I can counter trend trade this, or I can trade the direction. So I can trade this market from, I can trade this market going up until I get to this 38.2 level here. Okay, and that's where the reversal is likely to happen at that 38.2 level. So my overall outlook here is short term, the market is going to be bullish, but long term, we're looking at more so on a bearish market. So what I'll be doing is my setup, I'm going to wait for this to get triggered. So I'm going to do a call level at 111 or 11715. And once this call level is triggered, basically now I'm going to be thinking about shorten this market after I check those indexes, of course. Now, if I was, to be day trading or something like that, Monday and Sunday are basically trap days. So today is not a good day to be trading. You want to trade Tuesday to Thursday. So you don't trade Friday either. So by tomorrow, we should be at this area. I should get a call level alert to this area, and I can start to counter this move. But that's because I'm looking at this higher time frame. So if I'm looking at these smaller time frames, which is what I teach in your very early stages of you learning how to become a Forex trader, I teach you how to trade these smaller time frames. It looks like a lot more fluctuation of price. The market is basically, kind of going rampant in that sense. You don't have a sense of direction with this. Okay. Now, like I said, you can take the market up. I can buy this market like we literally sitting on one of my channels, which is the beginning of a bullish uptrend. I could buy this market short term if I want to. Okay. But I'm looking to counter for a lot more pips. Okay. In all reality. Now, I'm going to also check the news, which I've already done. So see, this is here about 30 pips that you can possibly catch from the bullish rally, which is what makes it not worth it to me. Okay. Now I got some other triggers that I kind of set up. If you look at my chart is kind of already pre-set up. So I know what to expect at each level. These little, dots or arrows, I place these here myself based off of me already reading my setup and interpreting it in the way that I understand and the way that I teach you to understand. So in all reality, what I'm going to do real quick, I'm going to go to a totally a complete empty pair. So I'm going to redo a basic setup real quick. But I want to talk about some general concepts, some of the secrets behind trading first and foremost. So first off, let me finish my train of thought. So as I said, with USDJPY, I'm looking to sell at 11715, kind of counter trend trading, trying to get this move. But anyway, that's a whole nother story. What I actually want you to always be doing, though, is making sure that you check the global economic calendar. You can Google global economic calendar on Google, or just Google dailyfx.com/calendar, and this calendar will come up. Now, what this calendar is telling you is giving you all the news that's relevant to your specific currency pair. So you can see today with the Japanese yen, we got some medium news that kind of was released to the public, right? And that had an effect on that US dollar, or that Japanese yen, pardon me. They had an effect on that Japanese yen. Now, in this case, let's see, what time does it come out? Oh, I think it came out. I don't see the new numbers yet. They haven't updated it. But anyway, so what we want to do is we mainly focus on the high news releases. Okay. Now you can interpret it, in multiple ways, but the way that I was taught how to read this news is that if the economers forecast, let's say in this sense, 3,107 billion for this foreign reserves for this Chinese yen, right? If that number, the actual number in this sense, if it comes in lower than what economists estimated, then it'll be a bad thing for the Chinese yen. If that number comes in higher than economists estimated, it'll be a positive thing for that US, or for that Chinese that Chinese yen. Okay. So that's just a basic understanding, of how to read this general information that you kind of have here. Now, they don't say hawkish or bullish like you would when you're looking at technical analysis. They actually say dovish or I say hawkish or bullish. I mean, they don't say bullish or bearish. They say hawkish or dovish. So hawkish means up. It's going to be a good thing for the dollar or whatever that currency is. And dovish means it's going to be a negative thing for that currency. Okay, so that's secret number one. Well, how the easiest way to interpret the global economic calendar. Okay, it's not all mumbo jumbo. This is the most important thing behind trading. Okay, is fundamentals. Now, today is not about fundamentals. Now, you can go through every day and kind of see. So what kind of affects that specific currency pair that you're trading. That's why you break it down as the US dollar versus the Japanese yen, because that's exactly what it is. It's the US dollar versus that Japanese yen. In that case, which one is stronger and which one is weaker than the opposite pair? Okay, so that's number one. All right, now let's go to a new chart real quick. So we're gonna go to, let's say, Euro USD. Here, you guys, one second. All right, so Euro USD, my bad, my internet started to mess up. Euro USD. Now, the first thing that you kind of looking at on Euro USD is you want to see on that daily chart what the overall direction is. Okay. Now you can see what that direction is on this daily chart just by looking at it first, right? You can see what that overall direction is just by looking at it. All right. Side note, all questions that you may have, If you're watching on our Currency Godz website, you can comment. There's a box below. You can ask your questions down there below, and I'll be able to respond to them. I'll get an alert for all questions, so you guys can ask questions that way. This is not an open topic webinar. This is more so on, I want you guys to listen and take notes. So again, the daily chart, when I say the direction chart, because remember, we use 4 time frames. We use the daily chart for direction, 4-hour chart for momentum, 1-hour chart for take profit and stop loss, and a 15-minute chart for our entry. That's not just labels. There's reasons behind it. You wouldn't, when you look at this chart, the first thing you should be doing is looking at where the direction is. The direction is currently going down. Okay, that's your natural bias. All right. For one, we know that the euro is strong, right? Or not the euro, the dollar is strong, but we want to check and see if that euro is strong or weak. So I'm going to type in EXY, which is the Euro Currency Index. So with this Euro Currency Index, it works the same way as I explained before. I want to see if it's strong or weak. So right now, the Euro Currency Index is weak. It's negative 22%. That's a good thing. Well, in this case, so if the euro is weak and the dollar is strong, that would make Euro USD go down. Okay. Now, the way that you look at it is that the dominant pair, whatever pair is listed first, you know, the euro is basically the direction chooser. If that makes sense. And what I mean by that, since the euro is not strong, the market can't go up, right? Since the euro is weak, the market kind of has to go down. And the next plus behind that is that the US dollar is actually stronger than the euro. It's actually strong. So in this case, we can count on the euro being weaker than the US dollar. So we would try to sell Euro USD. And that actually corresponds with what our sense of direction should have been when we looked at this chart. Just flat out looked at it with nothing on it. Okay, then you go through the basic setup. If you want to see some of the basic setup videos, you can look on YouTube, Currency Godz. You can just literally type in Currency Godz on YouTube and see the basic setup video. I really didn't want to come on here to talk about that today. Okay. One other thing that I wanted to talk about today was what we call session breaks. Okay, because there's something that happens during each one of these major sessions. So first, let's list out the sessions. We got the Asian session. We got London session. Then typically New York session. So we're just going to say these 3 sessions. Yeah, there are some, some crossover sessions that kind of mix in, like the Australian session and stuff like that. But we're not going, or the Sydney session, we're not going to talk about that one. Let's talk with these 3. Now, there's something really, really cool that happens during each one of these sessions. Okay. Now, during the Asian session, market retraces. Okay. So this is a retracement session. So let's say the market was going up during London, or the market was going up during New York. Once the Asian session hits, it's going to start going down. So that's what a retracement basically means. Okay. London session. This is the true trend. So what that means is that, so the true trend, that means that whatever trend was set, that's the way the market is going to go after that. All right. Then you got finally New York, but we're going to place them in order. All right. So New York is the new trend. And this is how the cycles go in trading. Okay. Now, New York session is basically the first session. It starts off everything. Then you got Asian session that comes next. New York session basically starts off at 8 in the morning, 8:30 in the morning or so. And it starts a new trend. Then around 5 o'clock p.m., Asian session opens up. And now the market starts to retrace. Okay. Then you got 2 a.m. Now London session is open. Now the market starts to go through a true trend. And what's happening is whatever the direction was set during New York session, that's what's going to happen during London session. So if New York session set to go up, set the market to go up, then you retrace during Asian, then you go back up during London. So that's the way that the markets are moving. It's a cycle. And the way the name, if you want to label these cycles, you got the beginning, confirmation, continuation. Okay, in order for a trend to be confirmed, there has to be a retracement. The market has to retrace. Now, how can you know what time frame is what? Very, very easy. Let me show you. We're gonna come here and we're gonna go to time scale and click on session breaks if it allows me. For some reason, it won't let me. Yeah, for some reason it won't let me. Anyway, session breaks basically breaks down each session. So right now we're in the right now it's 1:00 p.m. We literally just came out of New York session and we're in Sydney session right now. Okay, so semi still New York session basically. But I wanted to show you guys the session breaks, but for some reason, I guess TradingView has changed something, or they always doing something. So that's not gonna work. But anyway, that's the key thing to remember. Each one of those sessions has something in particular that it does every single time. Okay, so that's number one. All right, the second secret. All right. Now we can stay on this pair. This is actually cool. This is actually a good pair. All right, so now the next thing I just kind of want you to know, you might heard in some of my previous videos as well, is that the price levels that you see when you trade. So these numbers right over here, that's actually the conversion rate. Okay, so that's the conversion rate. If you convert €1 for $1, instead of you getting 199, or instead of you getting 100 pennies, you would get 115 pennies. Okay, because $1 converted to €1 is 1.15. So that's the actual conversion rate. So when people be like, "Oh, Forex is scam, da da da," it really doesn't make sense, because this is like, they spend money, they use currency, so therefore this is the actual understanding behind what that means. Now, what we do as traders, we're actually trading that floating exchange rate, because that exchange rate is constantly changing, based off of the circulation of the currency. Now, one of the most misunderstood concepts behind trading is what's actually moving the markets. Okay, so what's actually moving the markets, as some of you may or may not know, is the expectations of other traders. Okay, now supply and demand is one thing, but supply and demand can only actually be supply and demand if you have a good or service that I need at that specific time. Okay, now that doesn't mean that supply and demand is not moving the markets, because there is an aspect of it that is. But as for traders, what trading was moving the market is the traders. Okay, because everybody's expectations are different. So this is why it's good to learn strategies that you can implement and use, because everybody is using some sort of strategy. All right, now if your strategy is changing every week, that's probably the problem why you're not being as profitable as you want to be. So you want to stick to something that works and learn everything you can about that strategy and keep applying it, keep using it. Okay, so that's number one. But as I was saying, the expectations of other traders is what's moving that market, and that's what's causing the market to create these waves. That's basically that fluctuation of price, because their expectations are constantly changing based off of psychological levels. As the market gets to these certain levels, those expectations change. So we want to have a clear view on what's actually happening in the market. So I'm gonna actually go back to USDJPY real quick, and in order to get this concept to you, to let you understand. Now, when I started this setup on USDJPY, I started this setup on a higher time frame for a reason. Now, the reason is that when the market begins to make those higher highs or lower lows on that 15-minute and that hour chart, basically the higher time frames is going to take 12 hours. Okay, 12 hours, and let's say make 3 candlesticks on a 4-hour chart. So basically it took all of that volume, calculated it and seeing which one was greater. Was it greater momentum for the buyers, or was it greater momentum for the sellers? Okay, so this is what the advantage with higher time frames are. We only get to see the actual volume, the actual movement. So with this particular setup right here, I'm at an advantage for that fact that I got higher time frames that's kind of telling me certain zones, 38.2 zones, supply and demand areas, accumulation zones, pendants. Like, this stuff is allowing me to see that. So let's review right here on this this specific timeline, or this specific time frame, the 15-minute chart. So again, on this 15-minute chart, what we're waiting on, or what I'm kind of expecting to happen, is the market pulling up first, you know, to this 111,715 zone, and then retracing. Now, why do I say that it's going to retrace? I know a lot of you may be wondering that. Now, there's something called, you know, an active and a pause movement. So basically, the market trading Forex is kind of like chess. Okay, too many people approach trading Forex as checkers instead of chess. With it being chess, you have to realize that the market has to be prepared and setting up the next move. So therefore, there's an active move, but there's a pause move, and that active move can't actually play out until that pause move is set up. So how do I even know where those active and pause moves are? Well, that's what we use our 38.2 zones for. Our 38.2 zones, with the simple concept of 3 consecutive candlesticks above or below that area, identifies the volume of that specific direction in the market, or identifies the specific direction of the market. You know, so if I get 3 consecutive candlesticks above a 38.2 zone, basically the direction to be bullish. Okay. If I get 3 consecutive candlesticks below a 38.2 zone, basically the direction will be bearish. So in this case, I set up a bearish direction, which is my first active move. But then the market retraced. As I said, the market can't make lower lows or higher highs without retracing first. So it retraced and it tested this 38.2 zone again. And it created 3 more consecutive candlesticks below this 38.2. So now I have an active and I have a pause move. Okay, so now the next time I go to this 38.2 range, I can expect for the market to pull down. Now, I do have a few other triggers, because that 38.2 zone is called a trigger. I used a few other triggers, such as channels. I use support and resistance, accumulation zones, 38.2 zones, all things that I teach. All right, so I actually just wanted to, you know, kind of give you guys an overview on what I see happening for at least one period a week, and give you guys some, you know, some tips of the week. So I'm going to do this every single Monday. You guys can tune in at the same time, 1:00 p.m. on the dot. We're going to, you know, tear apart some currency pairs. I'm going to drop some tips. If you guys ever want to learn more information about what I do and how I teach individuals, or become a student yourself, there's a link below in the orange box. It's going to say learn more for $39 a month. You can get access to Financial Alchemy Pro, or you can join some of the other, you know, cool, you know, organizations that we have built for traders. So again, you know, I'll see you guys on the other side. If you guys got any questions, contact me on Facebook, Robert Ritchie, or drop a comment in the box below, and I'll be sure to get to you guys. But again, I appreciate all the love, all the respect, and I'm going to continue to do what I do. Again, everybody, you guys have a great day.